Welcome to the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie, and today, yield curves and is a recession around the corner in the US. One of our listeners wrote to us about yield curves lately, which has been in the news a bit lately because in the US, the yield curve for Treasuries is flattening, perhaps eventually inverting. And guess what? Prior to every recession in the US, that's exactly what's happened. So does that mean all this bravado about the strength of the US is wrong and a recession is on the way? We'll look at that today on the Debunking Economics podcast. So this listener wrote to us and said a recent Financial Post article made a point of repeatedly mentioning that it wasn't understood why yield curve inversion is a reliable predictor of recession. He says, I figured it's because banks borrow short and lend long. So inversion would cause banks to scale back credit creation, leading to a recession. Would you care to weigh in? I'd appreciate assistance in making sense of this. So let's see what Steve thinks. First of all, though, Steve, this is uncharted territory for a lot of people. So let's look at the basics of bond yields. They change largely because interest rates change. If I buy bonds, say they're worth $100 each, when the interest rate is 5%, I'll get a payment of $5 per year in interest and $100 back when the bond reaches maturity. Normally, of course, I'm not going to hang on to it for the entire duration. I'm going to sell it on at some point. But if the interest rate in the meantime has changed to 10%, then new bonds are going to pay out more. So who's going to want to buy my bond, which is paying out only 5%? So I have to sell my bond for less to compensate. So rising interest rates push bond prices down, or more accurately, the prospect of rising interest rates push bond prices down, and the other way around. Now, when I sell my bond for less, I also need to factor in that the buyer will still get the $100 when the bond expires, even though he is or she is paying less to me than $100. So what's called the yield to maturity, sometimes called the gross redemption yield, is worked out based on that capital gain or that capital loss plus the interest that's getting paid. It's basically the difference between how much I paid and what I'm going to get repaid when the bond matures, and the coupon rate with the actual amount paid based on the interest rate when the original bond was issued. If that's not complicated enough, bonds are offered with different periods of maturity, anything from 1 month to 30 years in the case of US Treasuries, which are issued by the Federal Reserve, the Fed in the US. Now, the pattern over those various periods, based on the currently traded yield to maturity rates, that's the movable rate, not the fixed rate at which the bond is issued, but the trading rate, is what's called the yield curve. So, Steve, I hope that makes sense to you. Does that sound like an accurate description as you understand it?
Except that the yield curve actually is devised by deducting the interest rate for a particular term, maturity versus a shorter maturity.
Yeah,
and but
that's what I was saying. So you've got basically got the traded rate for each period from 1 month to 30 years, basically, and it changes over time. Now, you'd expect short duration bonds would be closer to the current interest rate, and longer term bonds, because you're tying up money for a bit longer, you'd expect a better payback. So when those bonds are issued, the interest paid is going to be a bit more. So if nothing was traded at all, then a natural yield curve would be rising. The longer the period, the higher the interest, which is the normal shape of a bond curve, basically, isn't it?
Yeah, that's the usual shape. And what's worrying people at the moment is we're heading back to the stage where it's actually an inverted shape. And that's the reason that one of our supporters on Patreon asked us to talk about this a bit.
Yeah. Well, and so the obvious question is, why would that happen? And the obvious reason, if you're just looking at the theory behind it, is because investors expect the interest rates are going to be cut, because then the longer bonds are going to have a better rate than the newer ones being issued. So everyone's going to rush for the longer term bonds because they're going to say, look, you're paying a better interest rate than the ones that are going to be issued, so I'm going to get yours instead. And that's going to put a squeeze on prices, and it's going to mean people are prepared to pay more, I should say. So that compresses the yield. So that's the logical reason why. And yet the Fed is telling us, no, we're on a path to increase interest rates.
And I think they're going to maintain that path too. So, and I think also, my expectation is the next recession will be caused by the Federal Reserve.
Right. So does this mean people trading in yields have got a clearer idea than the Fed? Because obviously, I mean, if that is the logical explanation, that means they don't believe the Fed.
Yeah, but it's also, a possible explanation. And this is not an area of my expertise, by the way.
Right.
You and I discussed beforehand. It's something which I focus more on the macro, dynamics of credit and so on. Everybody, that's what I hammer on about all the time. This one, I have a couple of speculations about it, and one of them is that one of the reasons this might be when you see an inversion of the yield curve, you get a higher interest rate for short term than you get for long term. As you've explained, the interest rate on a bond goes in the opposite direction to its price. So if price is falling, then its yield is rising.
Yeah.
Now it's if you have people buying short-term bonds, driving up the price, then the yield will fall. Now, it's possible that what we're seeing is people short-term need for liquidity turning up in the prices they're paying for the bonds. And I haven't worked it out. I can't say that I've got a definitive view here, but it's possible to me that the reason that the inversion of the yield curve has been a fairly reliable indicator of recessions in the past is that this reflects people's need for liquidity at some point and being passed through onto the bond market.
But it becomes, the easiest way of looking at it actually does become a supply and demand question, really, doesn't it, at the end of the day? A flow of the supply. Let's put this in the terms I want people to get used to thinking. When you're talking supply and demand, don't draw a couple of static curves. Think about the flow of demand per year and the flow of supply per year. Yeah, exactly. Well, the price that people are prepared to pay. For bonds of various duration, is obviously factored in what you think you're going to get from it, but also the supply of them as well. So, could it, if there's a lot of people wanting long-term bonds, then they are concerned about the future, really. Otherwise, why would they be buying bonds? Why wouldn't they be buying money that's going to pay them, put their money in something which is going to pay them back quicker?
Equally, if people have a need for liquidity, turning bonds into cash so that you can pay some short-term pressures, then my conjecture here is that if people wanted to get rid of the most liquid, the best way to get that money in a hurry is to sell the most liquid item you hold. If that's going to be short-term government bonds, you sell them, the supply rises in that sense, the flow of supply at a particular point in time rises.
Yeah.
So the price will fall, therefore the yield will rise, and you can get an inversion.
Right.
Now, I've got this. This is what I'm thinking. Again, I haven't looked at the data. I can't say that that's the definitive answer, but that's the feeling I've got, that there are short-term liquidity needs turning up because a range of positions people have got are not working out the way they thought they would, and then bang, this is going to drive that short-term yield up because the supply of bonds is rising.
Well, this is a fairly involved discussion about yield curves, how they work, and whether they are actually a good predictor of a recession, and whether that means there is one just around the corner in the United States. To find out more, you'll have to listen to the full version of this podcast. It goes on for about half an hour. To do that, you need to become a subscriber at debunkingeconomics.com, or you can become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen. If you pledge $10 or more support each month, then you'll get access to the full version of this podcast and all the other ones in this series. I'm Phil Dobbie. Hopefully we'll see you back here again for the full version of the podcast. We'll see you again very soon. Thanks for listening.